We will now begin our first session on definitions, measures, and the roles of global liquidity. The moderator for this session is Dr. Sullivan, who serves as Executive Vice President at the Federal Reserve Bank of Chicago. Please welcome Dr. Sullivan. Please allow me to make a note for session flow management. When you wish to make a comment or question, please place your nameplate on end. And if you are sitting in the back, so that we cannot see your nameplate well here, and then please raise your hand and identify your affiliation before asking questions. Thank you.
Excuse me, already messed up. Anyway, I just repeat that I'm very happy to be here, honored with the chance to moderate this panel at the Bank of Korea. And our first speaker is Benoit Cœuré from the European Central Bank.
Well, good morning to all of you, and let me first begin by thanking the Bank of Korea for their kind invitation, for the excellent organization, and also for choosing this theme of global liquidity in a global framework as a leading theme for this year's conference. It's very important that the central bank community makes further progress on this important issue of global liquidity. We got to this point starting from G20 work in 2011, starting from the seminal reports that Jean-Pierre Landau, who's here today, led at the CGFS on global liquidity. And we're now moving further along the learning curve, and I very much hope personally to learn a lot from this conference. What I would like to do, just as a matter of introduction for the discussion, is to share with you a few views on the role of global liquidity, on the measurement and roles of global liquidity well, consistent with the title of the session. Also bringing into the picture the European angle and the experience from the Eurozone, which can shed light on some of the issues that global financial markets at large are now facing. And an important observation with regard to the drivers of global liquidity, again starting from the important work that has been done by the CGFS, the Committee on the Global Financial System, is that first there are many dimensions to global liquidity, many indicators which are now nicely summarized and outlined in CGFS work. That this includes both official liquidity and private liquidity, and also that private liquidity is endogenous in the sense that it's proven to be highly procyclical. It's highly endogenous to the conditions that prevail in the global financial system, and it's also related to the degree of risk appetite in the system. So it's this endogeneity of private liquidity that makes it so difficult to understand and to measure. And this is why we need several indicators, both price-based and volume-based, and this is what the CGFS and also the IMF have been doing. So a relatively large set of indicators have been proposed to monitor trends in global liquidity. And of course, what's difficult at this stage is to make sense out of it, to make sense of this wealth of different indicators related to global liquidity. And here I would like to refer maybe to try to put some structure on the discussion, to refer to recent work that has been done by Eickmeyer, Gamba-Corta, and Hoffman, working at in several European institutions and as published by the BIS. They've used all the set of indicators produced by the CGFS and tried to put some structure. And actually, they have a nice paper identifying three main factors driving global liquidity, namely three factors related to monetary policy on the one hand, then credit supply, and finally credit demand. So I like this paper because it kind of maps the whole set of indicators of global liquidity into 3 dimensions, which already is very helpful to organize a discussion. I'm not going to go into the details now, but these liquidity factors are quite helpful to tell the story of what happened to global liquidity before the crisis and after the crisis. Before the crisis, a surge in private liquidity, inside liquidity, which also was conducive to an expansion of global credit supply, and after the crisis, a substitution by official liquidity, public liquidity, replacing contracting private liquidity. So you can tell the story of the crisis using this set of indicators and summarizing them into these 3 dimensions. So I'm not going into the details, but I'm just using these slides to show you that the analytical work has been making rapid progress, and now we have a better comprehension of the driving forces of liquidity based on the CGFS indicators. So that's just a little bit of advertisement to this line of work. Also, what's interesting is that this makes it possible also to identify regional differences in the drivers of global liquidity. And for instance, again, in the same paper, when you contrast developing economies and emerging market economies, and when you try to illustrate, for instance, the contribution to M2 growth, so to money growth, coming from these different factors, this is what you have on the far right and bottom panel of this slide. You can see that at the global level, you can see the correlation between credit supply and demand factors with M2. But when you break it down into regions, you can see that M2 is better explained in advanced economies, and in particular in Europe, by credit supply. So the intermediated finance, the situation of the banking sector was instrumental in driving liquidity in Europe. While in Asia, for instance, M2 is more related to macro factors and not particularly to this credit supply factor. So by going into the details, you can understand also the transmission of global liquidity in an intermediated way or in a disintermediated way. What's the policy discussion now on global liquidity? And the point I would like to make now is that there have been maybe too much emphasis. There is today too much emphasis on the international spillovers of monetary policy, so on global liquidity flows seen as byproducts of monetary policies undertaken in advanced economies, and that's the whole discussion on the spillovers from QE in particular, which was already mentioned earlier this morning by the lead speakers. And that there may be not enough emphasis, or this may be overlooking the biggest picture and the more long-term picture of the kind of international risk sharing that is made possible by global liquidity flows. So too much focus on short-term flows related to monetary policies and insufficient focus on risk sharing and on the structure of international capital flows. Let me illustrate this point, for instance, by saying a word on the discussion on the spillovers from QE. Here I would like to refer to research made at the European Central Bank by Fratscher, Loduca, and Schraub. They've been quantifying the external spillovers of QE in the US, QE1, QE2, and QE3. And what you can see from this table is that they find significant but still relatively limited international impact of QE, and maybe more interestingly, different impact from the different phases of QE, meaning that QE1, which was more targeted and aiming at targeting market malfunction in a sense, had a relatively limited impact on global markets, while QE2 which was large-scale asset purchase, had a more significant impact on global markets. And also what they find, and that's also relevant, is that the monetary policy contribution to equity flows to emerging market economies is again significant but limited, and that other factors, in particular pull factors arising from conditions in emerging market economies, like the macro cycle in emerging market economies, in recipient economies, these macro factors were more important actually than monetary policy factors. So in a sense, what you can draw from this kind of literature is that the international impact of unconventional policies may be in a sense, overstated. There may be too much focus on the international impact of unconventional monetary policies. And the point I would like to make at this stage is that this discussion, focusing very much on the international impact of QE and on liquidity flows arising from QE or from unconventional policies in major economic areas, overlooks the fact that historically, and from a long-term perspective, global liquidity is closely intertwined with the degree of international risk sharing. So I'm not going to come back to the whole story of, perfect versus imperfect markets. I mean, this has been made much better than I would ever do in the introductory speech. And so we know very well that also international liquidity flows have a risk sharing function. And that in principle, with a perfect set of contingent financial assets, countries will be able to disconnect their consumption patterns from their output patterns, or to hedge their consumption patterns against idiosyncratic shocks. And we also know that financial markets are not perfect, but they share some common feature in the way they are imperfect. So if maybe I would challenge the Tolstoy quote that was used by Tom Sargent earlier this morning, that certainly perfect markets are all alike, but imperfect markets also are similar in some ways. And what I would like to try to illustrate is that what happened in Europe, within the euro area, within that particular region, can illustrate some of the general features that you see also at a global level. So the kind of imperfections that we've seen in Europe since the crisis has erupted can also teach us lessons on global international markets. So as we know very well, one simple way to gauge the extent of international risk sharing is just the share of the size of foreign assets as compared to GDP, and this is a very well-known figure where you see the first wave of globalization before the First World War, and then you see the extent to which the second wave of globalization since the 80s, 90s has increased the extent of risk sharing through international capital flows. What you can also see, and that's important for the policy discussion, is that the impact of the crisis has been that the extent of international risk sharing through international capital markets has leveled off since the beginning of the crisis. This you can see at the right-hand side of the figure, and you can see that now globalization has come to a halt. And as I will illustrate in a moment, you may even argue that in some cases globalization has retreated, so that the crisis has led to financial fragmentation or de-globalization on international financial markets. So here you can see this trend of rapid financial globalization, and this is at the global level in OECD countries mostly. You could see the same pattern within Europe. The euro was introduced in 1999, so at the midst of this period of rapid financial globalization. So it's no surprise that within the eurozone, in a region where exchange rate risk had been suppressed, we've seen the same kind of expansion of international risk sharing that we could see at the global level. So we've seen rapid expansion of cross-border financial flows within the euro area. But and there is a but, with the benefit of hindsight, we also know that this risk sharing was not the right one in the sense that risk was not well assessed. It was not well monitored, and this kind of unchecked cross-border lending that we've seen in Europe has supported projects with low intrinsic profitability, like housing projects in peripheral European countries. And we could also see that the structure of these cross-border flows in Europe was mostly wholesale interbank credit rather than direct lending to companies or to households, and rather than capital market investment. And it was inherently fragile in the sense that when confidence was eroded by the crisis, the whole system fragmented along national borders. The wholesale interbank market was not robust enough to confidence shocks, and it was very much dependent on the backstop provided by national governments. So the lesson from Europe at this stage is that you can have apparently an expansion of international risk sharing through capital markets, but there are different ways to achieve it, and it can be done in a robust way. It can also be done in a very fragile way, and this is what happened in the euro area. Let me highlight two features of this wave of financial globalization, which in my view are particularly important. The first feature is that international risk diversification and international liquidity flows go together with wealth transfers, wealth transfers across space, across countries. And let me use the well-known example of the US, of the balance sheet of the US economy. We know very well that before the crisis, the US economy as a whole, in the aggregate, was invested in risky assets, in equities outside the US. While the liabilities were safe assets, meaning T-bills and T-bonds mostly. So as was well illustrated, for instance, in a paper by Pierre-Olivier Gourinchas and Hélène Rey, the US acted as insurers for the world, investing in risky assets and financing by issuing safe assets, meaning that when the crisis hit, you could see a massive massive wealth transfer, meaning losses on the balance sheet of the US, again in the aggregate, and transfers to the rest of the world, as materializing this global insurance function of the US economy. And again, within the euro area, so again, moving back and forth from the global economy to the European economy, you could argue that Germany, in a sense, played a similar role of insurance provider within the euro area, investing into risky assets before the crisis. So German banks lending to Spanish banks to expand their real estate investments, for instance. So investing in risky assets before the crisis, but also providing liquidity and taking a part of the losses when the crisis hit the region. So you have, again, a similarity between the role of the US in the global economy and the role of Germany in the European economy. Now you can say that the US runs a current account while Germany runs a current, the US runs a current account deficit while Germany runs a current account surplus, as we know. But we know that in our modern economies, there can be a disconnect between the risk-sharing function and the patterns of capital account surpluses or deficits. So this doesn't necessarily have to do with the pattern of global imbalances. So that's the first feature of this globalization is that this leads to wealth transfers. And here, what is probably underestimated by the academic literature, if I may, is that together with wealth transfers, you have political consequences. So the political economy of this insurance function is maybe overstated by the academic literature, meaning that the insurance function played by either the US at the global level or by Germany at the European level, it can be ex-ante efficient because it's insurance provision, but it can be ex-post difficult because when you have to transfer the risk, when you have to take the losses, of course, it's politically difficult to accept. So you can have a system which is efficient ex-ante, but with a risk of contradiction or inconsistency exposed when losses materialize. So that's the first theme. The second feature I would like to highlight, which is also apparent in the current literature, is the role of cross-border banking in international capital flows and the interaction between global liquidity cycles and the leverage of global banks. And this is also well understood now, so I'm not going to expand too much, but we know that the expansion of cross-border lending before the crisis was made possible by increased bank leverage in the period where risk was perceived as being low. Or in other words, and to use the words, the nice expression by Borio and Disiatat, there was excess elasticity of the international financial system or excess elasticity of credit supply because of this interaction between the global liquidity cycle and the leverage cycle of global banks. And we could see that before the crisis in an expansion mode. We can also see that after the crisis in a retrenchment mode, meaning that following the crisis, global banks have retreated from cross-border lending, and they have amplified the impact of the crisis on those economies that did not have alternative sources of funding, prompting a substitution by official credit, so either IMF lending or EU lending in the case of peripheral European countries. So this is an important point because it showed that any policy discussion on global liquidity cycles and generally on international risk sharing also has to focus on microprudential, on the microprudential framework, since the global liquidity cycle has so much to do with the risk appetite and the leverage capabilities of global cross-border banking groups. So it cannot be seen as a macro issue alone. There is an interaction with the microprudential discussion. So what happens since the crisis? We've seen this retreat of international capital flows and to some extent deglobalization or financial fragmentation. We've seen that in Europe. On this figure you can see, for instance, non-resident holdings of government debt securities in Spain and in Italy, which gives an example of the extent of renationalization of savings in countries like Spain and Italy. What is important to note here is that this renationalization of savings or this fragmentation, in some cases, has been encouraged by public intervention. In particular, government bailouts have reinforced the link between banks and sovereign credit, leading to or encouraging or reinforcing financial fragmentation. Also, the ring fencing of capital and liquidity globally by supervisors has constrained the ability of banks to take risk outside their domestic jurisdiction. So here the lesson is that what's happening now as a reaction to the financial crisis, it is shaping the future geography or the future patterns of international risk sharing, but in a way which is also heavily influenced by regulatory reactions and policy reactions in domestic jurisdictions. So there is an interaction between a kind of steady-state institutional framework, but also policy reactions in various countries that can influence the degree of deglobalization or the degree of financial fragmentations, and that can have a potential to have long-lasting impacts on the pattern of financial flows. So this is at the European level. At the global level, also you can see a home bias in a period of deleveraging. For instance, on that figure, where you have plot domestic lending against international lending, you can see that in the post-crisis period, the relation between international lending and domestic lending is tight. The slope of this relation is steeper than before the crisis, meaning that the retrenchment of domestic lending has come together with it had a higher impact, a more pronounced impact on international lending. So there was no substitution between domestic lending and international lending, quite the contrary. So, and this is evidence of a home bias in deleveraging. You could have other examples. Here, this is the traditional Feldstein-Orioka type correlation between investments and savings cross-country. On the left panel, you have the euro area. On the right panel, you have the OECD. And what is very striking on this figure is the amount of recorrelation between domestic savings and domestic investment following the crisis. So that's, again, evidence of the renationalization of savings or fragmentation of the global financial system at the global level, and even more visibly here at the European level. So will that be lasting? Will this fragmentation of global financial markets be lasting? Will this regionalization of risk sharing be lasting? What's also important here is that this comes together with not only with fragmentation at national level, but also with regionalization of saving and investment flows. For instance, we know the role that European banks have played in the global dollar market in the period before the crisis. We've seen European banks retreating from global intermediation in US dollar after the crisis, as you can see on that figure. And as you can see on the next figure, you can see that the space created by the retreat of European banks in Asia in particular has been filled to some extent by Asian banks. So we've seen not only renationalization, but also regionalization of savings and investment flows in the period following the crisis. So an important question for future research is whether this regionalization of international capital flows is welfare enhancing or not, and there can be different views. But here, from a European standpoint, I would be rather cautious. What we've seen in Europe is that the single currency, so a deliberate attempt to have a regional market for capital in Europe, has made participating economies probably more robust to global shocks. And we've seen that repeatedly between 1999 and 2007, but it has made them more vulnerable to regional shocks, as we've seen since 2010 with the euro area crisis. So there are pros and cons, but it's not at all sure that this regionalization of savings will be welfare improving for the global financial system. So let me conclude. What I would like to highlight as a conclusion is first that as I've tried to show in this presentation, we've seen the crisis resulting in fragmentation and some regionalization of international capital flows with a risk of financial protectionism in many jurisdictions. This should be avoided. So the world has gained a lot from being financially open. Global growth has gained a lot from international financial integration. So there are lessons both for emerging market economies and for developed economies. Emerging market economies should refrain from reacting too strongly to international spillovers from non-conventional monetary policies. And as was clearly said by Mr. Shinohara earlier, capital flow management measures are always possible, but only after macroeconomic measures have been taken. Also, there are lessons for advanced economies, and here the lesson is to resist financial protectionism and to resist enforcing national regulatory responses in response to this perceived fragmentation of international finance. So this is why it's so important to have a level playing field in implementing the new financial regulations. And this is also why at the European level it's so important to have a banking union, meaning not only single supervision, but also a single resolution mechanism, so that capital can flow freely again within the monetary union, which is, as I illustrated, no longer the case, unfortunately. And finally, we need a series of measures addressing both the excess elasticity, again in the BIS sense of global credit supply, which have to do with micro-regulation and macro-regulation. And also in complement, we need further reflection on the provision of public liquidity when private liquidity retreats. So this is the whole discussion on global financial safety nets. But if we believe that the trend towards regionalization of international capital markets is lasting and significant, then this would prompt even more reflection on regional financing arrangements and on the interaction between regional financing arrangements, such as the Chiang Mai arrangement or the European Stability Mechanism and global financial safety nets. So this will remain a lively discussion for the years to come. But what I would like to conclude here is that the discussion on the provision of international public liquidity can be misleading in the sense that it can be seen as a substitute for more resilient for more resilient private markets and for better risk management in the private sector. Here there is no trade-off, there is no substitution. Or to borrow from the theory of insurance, we need to strike the right balance between ex-post efficiency and ex-ante efficiency. So ex-post efficiency requires efficient public liquidity provision in times of crisis, global financial safety nets or regional financial safety nets. This is ex-post efficiency, but ex-ante efficiency requires strong risk management in the private sector both at the, from a microprudential perspective and a macroprudential perspective. So the reflection on global financial safety net should not be a substitute for stronger risk management in the private sector. If we want public balance sheets to be able to expand in a crisis, they have to be kept at a reasonable size before the crisis, and they have to be able to retreat after the crisis. And this is why the reflection on exit from unconventional policies is so important, that we have to scale back the size of public balance sheets, in particular the size of central bank balance sheets, in order for private transactions to thrive and to play their price signaling role. Thank you very much.
Thank you very much for that interesting speech. Our discussant is Kwon-ho Shin from Korea University.
Thank you, Chairman. I'm very privileged to discuss this very interesting paper in this wonderful conference. And I really thank the organizers for inviting me. And this is a very interesting paper, but the problem was that I received it just yesterday, so I didn't really have much time to think about it. So let me start with the summary of the paper. This paper tries to provide some policy implications based on the improved understanding of the concept of global liquidity. And Mr. Gray, points out that the current discussion focuses mainly on the transmission of negative aspect of global liquidity. But the concept of the global liquidity is closely related to the notion of international risk sharing that could be welfare improving. But he worries that these days international risk sharing appears to have decreased or leveled off after the global crisis due to fragmentation and financial protectionism. So he argues that the first line of defense against unwarranted capital inflows should always consist in macroeconomic adjustment, not direct capital controls. And these capital flow management measures should be only used in exceptional case on temporary basis. So I have basically 4 comments, and my discussion will be organized in 4 items. The first item is that I talk about the concept of liquidity, and then move on to the issue of risk sharing. And I will, because he emphasized the positive aspect of global liquidity, I'll talk about negative externalities of capital flows. And finally, I will discuss the policy lessons. The first one is the concept of liquidity. I agree that there has been some improvement in the concept of liquidity, but in the morning, Professor Tom Sargent and Ms. Correa also argued that there is ambiguity still remaining in the concept of liquidity. And my concern is that a typical quantity measure of liquidity is traditional monetary aggregates, and its hierarchy is based on transaction role of money, so how cash-like it is. And based on this distinction, they have measures such as M0, M1, M2, and so on. I think that this is a good measure if your purpose is for the price stability. And this is also a good measure even for the financial stability if the traditional deposit funding dominates in the financial market. But as we know that during the global crisis, the shadow banking played much more important role. And in this case, I believe that there must be some alternative aggregate measure, which is useful, and that is based on core and non-core distinction of bank liabilities, and that focuses on who holds the claim. So recently, Hyun Sung-shin and I suggested this kind of, I pointed out many advantages of this distinction between core and non-core liabilities. Especially this measure is closely related to the risks associated with sudden funding reversals. And in that sense, it is very good measure when your purpose is for the financial stability. So what are core and non-core liabilities? Core liabilities are claim of ultimate domestic creditors, such as households and non-financial corporate firms. And on the other hand, non-core liabilities are claims on financial intermediary by another financial intermediary or foreign creditors. So this is the data I collected from Bank of Korea. And this first line, there's no pointer here. But the first line, the purple, is the one component of core liability, which is held by households. You can see that this is very stable. There's no up and down very much. But the second line, the blue one, is one example of non-core liabilities that is held by corporate sector. And you can see that it increases very rapidly. This is the crisis period, and you see that it increases very rapidly before the crisis and plummet. And this kind of sudden reversal of funding, that is a typical pattern, dynamics of non-core liabilities. And third one, the green one is the another example of core liabilities that is held by corporate sectors. And that is, again, pretty much stable. And finally, the fourth one is the another measure of non-core liability, which is held by foreign sector. Again, it increases very rapidly before the crisis and plummet. So this kind of reversal of funding, that is the typical feature of liquidity, and this can be captured by this measure of non-core liabilities. So I believe that we can get some better measure of liquidity based on this kind of distinction. And the second issue is risk sharing. He points out that international risk sharing is quite limited, and I agree with that. And he, in the paper actually, he showed, actually in the presentation too, he showed, Feldstein-Horioka puzzle. And there are many other puzzles related to this limited international risk sharing. The home bias puzzle, the consumption correlation puzzle, and the Becker-Smith puzzle. But I believe that some of these puzzles are very much related to the existence of nominal exchange rate. In particular, I found that the nominal exchange rate volatility is a main culprit of the Becker-Smith puzzle. And by eliminating this excessive volatility of exchange rate, we can enhance risk sharing. That's the reason why, in the Eurozone, in common currency area, we can have better risk sharing. But without introducing, common currency, maybe there must be some way to stabilize the exchange rate. I'll get back to this issue at the end of my discussion. And the third one is negative externalities of capital flows, because he, more emphasized the positive aspect of capital flows. I will spend more time on negative aspects, externalities of capital flows. As he pointed out, capital openness leads to many benefits, but it also entails costs. And two prominent costs are increased economic volatility and heightened vulnerability to crisis. But actually, these two are not, separate problems, phenomena. Actually, they are interconnected. And I found that the main channel through which capital market openness increases volatility is crisis. So in normal times, even though you have open capital market and large capital flows, you still have pretty much stable economy. But suddenly, if you experience crisis, then your output suddenly drops, and that contributes higher volatility. So the crises are the main cost involved with capital market openness and increased global volatility. I also found that there is some evidence that crisis we experience is more and more related to capital flows, international capital flows. So this is the regression I ran between 1990 and 2010. So this is the panel profit regression, and the dependent variable is the dummy variable, the price dummy variable. And you see that the credit GDP ratio, that is very significant. So if you have an expansion of credit, then it is more likely to experience a crisis. And you have the negative coefficient of foreign reserve to GDP ratio, which says that if you have enough reserves, then that can help prevent crisis. But if you restrict to the most recent crisis, the global financial crisis, you have a little bit different results. Here again, credit to GDP ratio is very significant, and real exchange rate appreciation becomes more significant. And actually, these two are the symptoms when you face large inflows of capital. So these variables are very much related to occurrence of crisis, especially for the global financial crisis. And the foreign reserves actually was not very helpful. They are not very much significant. So what would we do with this kind of negative externality? Econ 101 says that if you have negative externality, you impose a Pigouvian tax. But you need to be a little bit careful because the capital flows are not the same. We have different types of capital flows: foreign direct investment, portfolio investment, or foreign borrowings through bank loans. This is again Korean experience. You can see that this sudden positive inflows to negative inflows, that's most pronounced by the bank loans. The red bars are bank loans. But you see that the blue one, the equity flows, are negative long before the crisis. And during the crisis, actually, it is net positive. So this is the exchange rate. The exchange rate dynamics corresponds well with the dynamics of bank loans. So bank loans get positive to negative, then exchange rate hikes. So this kind of pattern is actually very general. So this is capital flows to emerging economies in general, and you see that the red ones again, the bank loans, suddenly changes from positive to negative around the crisis. So this kind of sudden reversal of funding is the typical feature of bank loans, and bank loans are actually the most important component of non-core liabilities. So what recently Korea introduced some macroprudential policies based on these findings, and that is the bank levy on non-core liabilities. And that has many advantages. It is automatic stabilizers because the base of levy actually varies over the cycle, and it is largest when we needed to impose most. And it minimizes impact of core intermediation because that levy is just imposed on non-core liabilities. And this leans against capital inflows and buildup of vulnerability. And he worries about capital controls, but this is not direct capital controls. And this is the purpose of this levy is for financial stability. So let me stop here. And I think that this is very interesting presentation, and I learned from it. But I hope that he spends more time on the negative aspects of the global liquidity and some policy lessons from it. Thank you.
We're going to give Benoit a chance to respond at some point, but no, please, Gary Gorton is our next speaker, and will present his paper.
Good morning. I, too, am going to talk about first what is liquidity, and then I'm going to look at some empirical evidence about this. So in the interest of time, I might go straight to some figures. Before I do that, on the first question, let me say that I think we can refine the question in two dimensions. First of all, the reason we're here today is because we think that liquidity has something to do with financial crises. So we ought to link any definition of liquidity to financial crises. And I would also point out that casual observation shows that financial crises are about debt. Without debt, there would be no financial crisis. So the burden on us is to explain how these three things are related, how debt is related to crises, and what this has to do with liquidity. Now, so just to be clear, a stock market crash is not a systemic event. Wealth might be lost, but it's not a systemic event. So in that sense, I'll talk about liquidity, and I'm going to summarize some work that tries to link these three notions. And I think in the process, I'll be able, hopefully, to categorize Tom Sargent's list of different kinds of liquidities in a certain way. And then I'll talk about the demand for safe assets. So let me go straight to this slide. I'm going to show you that there's essentially two kinds of liquidity. One kind is in markets and securities where information is produced. This would be the low bid-ask spread example Tom mentioned. And the other kind is where information is not produced. So the asset trades at par and it's redeemable at par. So you can think of a checking account, for example, or private banknotes. In this second kind of liquidity, there's no adverse selection, typically, and the security is going to be designed to prevent adverse selection in a setting where that's endogenous. So we want to design something so that no one has an incentive to produce information. So these ideas are developed in a series of papers, three of which are these three. Neither of the bottom two are working papers yet. They're in progress. Let me quickly summarize them. So in the first paper, we showed that banks exist to create safe debt. That is, there's agents who want to trade. They don't want to be taken advantage of by informed traders. And the bank is able to set itself up to offer them something that's safe, debt. But that paper didn't show that debt was the optimal contract. It showed that the bank was the optimal institution. The second paper does not assume that debt is riskless. It doesn't even assume debt. It says that debt is the optimal instrument for trading, and perhaps more importantly, debt is the optimal backing for that debt that's used for trading. Okay, so it's an optimal contract setting, but there's two different parts to this. When I trade, I want to use debt, and I want that debt to be backed by debt. Okay, so I do repo with asset-backed securities. It's very rare to do repo with stock, for example. And as you'll see, this is because we want to prevent information from getting out or from anybody having an incentive to produce the information. So the last paper says that, again, going back to institutions, banks are going to be optimally opaque institutions. And they're going to make loans to borrowers who don't have traded equity, small firms, households, and so on. So let me try to give you the intuition for at least part of these results, only one of the results. So here's a debt contract. Along the bottom, we have the backing of the final, the collateral value at maturity. And on the left, the y-axis is the payoff at maturity. So this is a very simple, very beautiful contract. It has two features. It's flat. That's the maximum you're ever going to get. And then there's a 45-degree line which says if they can't give you what they owe you, you get everything they have. Okay? So why would this be an optimal contract? What is the purpose of designing an instrument like this? Well, one way to note this is to imagine what the distribution of final collateral values could be. Suppose we're before maturity and we ask ourselves, what's going to happen at maturity? So let's just assume a distribution. Very simple. This is not what it looks like in reality, of course. This is a normal. But here's the distribution of collateral values. So the x-axis is the same as before, and the y-axis is the likelihood of getting that collateral value. So on the bottom part, there's different collateral values, and those are going to be realized with different probabilities. Now, let me put these two figures together. So the x-axis is the same in both figures, and I just want to imagine that the left axis has both things. It has the value of the debt at the end, and the different likelihood of collateral values. Now, the important thing about the whole story for part of our results is this picture. This picture says that debt has a very interesting property. The only area where this is going to be sensitive to what the collateral realization is in that blue triangle. If you knew that the collateral was going to be far to the right, you would know that this would be safe debt. If the cost of learning whether the realization is going to be in that blue triangle is higher than the value of the expected value of that, you would never produce information about this. So this is an example of an information insensitive instrument. It says that the cost of producing private information on the part of a counterparty is such that they won't produce the information. And so when I trade, it's common knowledge that nobody has an incentive to produce information, and it's very easy to trade no questions asked or with something that's above suspicion. Notice money has this property, right? Money has this property because the value of money, the distribution is shifted to the right. There is no blue triangle. Okay? And government debt, US government debt, you might think is that way as well, but even governments might have a little blue triangle, or it might even get bigger. So the result is that it's optimal to use debt to trade because it's efficient to be able to trade a larger amount with an instrument that is not sensitive to the production of private information. So the adverse selection is endogenous, but it doesn't happen. So this is what I just said. Now let's compare this to equity. So equity, the green line, is 0 up to the point where the firm is not bankrupt, and then to the right of the kink, equity just goes up. Right? So equity is always sensitive to information. Right? So the green line, when it has the upward vector, the upward arrow, the value, that always depends on what the backing collateral is. So equity is an example of a security that's information sensitive, and this is the one that's been intensively studied by financial economists, low bid-ask spreads, efficient markets and all that. And so when I take a set of cash flows and I tranche the cash flows into debt and equity, I'm tranching the information. I'm tranching the information so that the debt tranche is very insensitive if I've designed it right, and the equity tranche is very sensitive. Now, of course, we don't necessarily want the equity tranche to reveal information about the backing collateral for the debt. So we're always going to focus on settings where the backing collateral for the debt is not equity. So for example, asset-backed securities have no traded equity. They have no traded equity. This is going to make them ideal safe debt. Okay. Now, so this is what we end up with. We have a range of payoffs where it's information insensitive, and as we get close to the kink, there's a sensitive region. Now, what does this have to do with crises? So far, what I've tried to convince you of is debt exists to facilitate trade, because it's easier, more efficient to trade with something that retains its value and is not subject to private information. And that's going to be the definition of liquidity, or one definition of liquidity. Now, what does this have to do with crises? In this setting, a crisis has a very specific meaning. But before I talk about that, let me just go back to this blue triangle. Notice that if you want to minimize the value of information, which is the blue triangle, what would you do? If you're providing privately safe debt, what you want to do is make it very costly to produce information about that blue triangle. So what kind of securities would exist? They would be very complicated, very opaque securities, because those are the kinds of securities that it doesn't pay to learn the value because they're so complicated. And they're going to be backed by something which has a slow-moving value. Asset-backed securities, which are collateral for repo, are linked to portfolios of loans. So that's debt on debt on debt. Now, what can happen? Well, what can happen, the crisis here, is going to occur when the macroeconomy weakens and the distribution of collateral values shifts a little bit to the left. Then that triangle becomes larger, the red triangle. And if it becomes large enough, the value of this information, the red triangle, it may be that some agent wants to produce information about this. They either will produce information, and we have adverse selection, or I can make it not optimal to produce information by selling below the expected value of what the security is worth. So notice a crisis here has a very specific meaning. It's the transition from information insensitive to information sensitive debt. That says it's an information event. It's an information event. And you notice that the Treasury and the Fed are making billions of dollars on these trades now that fears of the red triangle have subsided, and the prices of all the other securities, debt securities, have rebounded. So this notion of the switch from insensitive to sensitive also gives a very precise meaning to the statement that there's a loss of confidence involved. So the bottom line here is there's a reason why there's a demand for debt, and the debt, in particular short-term debt, is used for transactions. However, that debt is vulnerable to a switch to being information sensitive. So debt provides liquidity, but debt can be vulnerable, and it can have a crisis. So this says that there's a reason there's complicated instruments. It says that opacity is something that's desirable, right? You don't want information about this backing collateral. You would rather be in a setting where nobody knows this. So if you compare this to, for example, to what I think of as the leading alternative, which is Rob Towns' costly state verification, in Rob's model, we want to monitor the borrower at the end. And we would like the cost of that to be very low, right? In this setting, where the debt's used for a different purpose, we want the cost of producing information to be very high. In his setting, it would optimally be zero. In our setting, it would optimally be infinity. Okay, so that roughly is how we've linked liquidity, debt, and crises. So let me now look at the demand for this kind of debt. So there's lots of different kinds of safe debt. Perhaps the leading example is government securities, which are not always riskless, but in the case of Treasury bills, we might think they're riskless. And then there's privately produced securities. Privately produced securities always have a little blue triangle, right? They're not riskless. However, we try very hard to reduce that blue triangle. So I want to show you this picture. This is a picture. Along the bottom is years, and along the top is percentage. This comes from a paper with some co-authors in the AER Papers and Proceedings where it defines all this stuff. But let me tell you what this says. This is U.S. flow funds data. It says the percentage of safe debt, either government liabilities, which are the bottom part, or privately produced debt, as a percentage of total assets. So total assets are skyrocketing, but as a percentage of that, the safe debt component has been insignificantly different from 32% since 1952. So we don't know why that is exactly, but I want to point out, first of all, it's been constant, which is kind of interesting, but I want to point out something else about this picture. The darker part is U.S. Treasuries, and so net of what the security fund is holding and so on. Notice that when that goes down, the private sector fills in, okay? And when it goes up, the private sector pulls back. So this has been verified with the following result, for example. If I look at the issuance with daily data of all asset-backed securities in the United States, I find that, one of my students finds, that the issuance occurs when the convenience yield goes up. In other words, when the price of your security is going to be the lowest is when you issue these asset-backed securities. So it's exactly this phenomenon. The issuance is happening when there's not enough treasuries. Okay, so you can see the problem here, right? The problem is going to be related to the mix of these securities. The mix of these securities. So So Krishnamurthy and Vissing Jorgensen have shown that this mix is very important, that when the ratio of privately produced safe debt to government-produced safe debt is high, the chance of a crisis is more likely. So this safe debt has this interesting property that the privately produced safe debt, of course, is not riskless, but if we don't have enough government safe debt, then we're going to produce private debt. Now, finally, let me just show you a couple more pictures, and then I'll sit down. Let me show you this picture. So this is the composition of the privately produced part of that previous picture. So if you say, let's just take the privately produced safe debt and ask, what is it? What is it? And you can see two interesting things here. First of all, the large part at the bottom is demand deposits, and you can see that that's in secular decline. The next two categories are money market instruments, like repo, for example, and the next one is asset-backed securities. And you can see how that's grown, right? The next two have grown. That's the growth of the shadow banking system. It's not a mystery. There's a demand for this kind of product. A repo is like a checking account. And if you want to hold an asset to transfer value through time, you're better off using debt. Okay, so there's a global demand. Before the crisis, there was this huge global demand for safe debt. And you can see the blue bar is the sum of the current account balance. And on the red, if you look on the right side of China in particular, you see acquisitions of U.S. treasuries and agencies, and net acquisitions of other U.S. assets, which is mostly ABS. And then if you look at OPEC, the bars aren't the same height because we have some data problems. They also demand a lot of treasuries, and other Asia demands a lot of treasuries. So there's a lot of treasuries, which is the safest debt, that are off the table, so to speak. They're off the table. So the global economy wants to produce some safe debt, and we're going to privately produce it. We're going to have a product, and the product is asset-backed securities. So in the case of Europe basically borrowed to produce, to buy asset-backed securities. Not sure why they levered up in this way, but the end result is a triangular trade that looks like this. The United States is selling safe debt, treasuries and agencies to other countries in the world. Europe is also selling safe debt, and the US is selling asset-backed securities to Europe. So there's a lot of mysteries about this. This picture and those other two charts come from a paper by Carol Berteau, Steve Kamen, and others at the Board of Governors. So what this suggests is that so-called macroprudential policy should focus on overseeing the private production of safe debt, not trying to kill it off, but trying to do something to ensure that the blue triangle is indeed small. So let me stop there.
Thank you very much. Our discussant is Mark Spiegel from the Federal Reserve Bank of San Francisco.
Thank you very much. Thanks to the organizers for inviting me to discuss these very interesting papers by Gary and his co-authors. The usual caveat applies that my views are my own and not those of the Federal Reserve. And then also an unusual caveat applies that the slides, I had to change my slides a lot because when I saw Gary's presentation, I saw that he wasn't going to concentrate so strongly on the underlying papers, and so you just follow along on the screen instead of in your binders. Well, I'll be okay. So let me start by saying that Gary takes off on this idea that we can distinguish between different types of assets in terms of their information sensitivity, and in particular distinguish between equity and debt in the sense that debt is, of course, less information sensitive than equity. Equity is, as an asset, is a junior claimant. Its value is going to vary directly with the fortunes of the underlying firm. So it pays a lot for potential investors to understand what the true values of equity assets are. In contrast, debt, because it's a senior claimant with a fixed payoff, in most states of the world, there's little gain to understanding the asset values because it's quite likely that this asset is going to pay off. And so debt, because of its simplicity and seniority, tends to be an asset that can avoid the acquisition of information by the purchaser of that asset. What Gary's trying to do in this research agenda is to explain crises. And what he argues, as he said a little while ago, is that all crises are essentially runs from bank debt, broadly defined. So we think about debt as these information-insensitive assets, and these are good things. These information-insensitive assets are cheap. They avoid the need for costly monitoring. But then a crisis occurs when an asset that we used to think was one that didn't need to be monitored becomes one that is what Gary and his co-authors refer to as information sensitive. And you could think of that as an adverse technology shock in intermediation. So we used to be able to raise funds for our projects in a rather cheap way. Now we can't do it anymore because we also have to pay for the costly monitoring that's going to take place. So the levels of activity that used to be sustainable under this preferable method of intermediation are now no longer attainable. They're unsustainable. And there's going to be some failures we'll see along the road, and that's how we get some crises. So of course, if we think about crises as a run from formerly safe debt, the basic idea that we'd start with is the traditional Dybbuk model, and I think we'll all feel old when we realize this is the 30th anniversary of the Dybbuk model. But as you probably most of you know, it's a model where we can get runs. Agents need short-term liquidity. But there's a common pool problem, and in particular, if agents think other agents are going to the bank to get their money out, then the guys who get in line first are going to get their money, and the guys who get in line later are not going to get their money. And so the run is because your actions depend on the actions of others. As Gary talks about in his overview paper that's in your binder, this kind of a framework can give you crises, but it's a little bit dissatisfying in the sense that it doesn't tell you why you get crises. In particular, you can move from a good to a bad equilibrium, maybe because of sunspots or what have you, but you don't know why you did that. And in particular, as Gary points out, you also don't know why crises end in terms of why you go back from the bad equilibrium to the good equilibrium. Is that another sunspot? You know, this model doesn't try to explain that framework. So what you'd like is some kind of a idea that would link the runs to fundamentals. And there we can move to some sort of belief coordination games. And in particular, papers like Morris and Shin and other papers that are more closely tied to fundamentals match some empirical evidence that does suggest that what we see in terms of crises are that crises typically occur at the peak of business cycles when we think conditions are very good. And this seems to suggest that you don't need a big shock to get a crisis. That's desirable, but you still need a common pool problem in a Morris and Shin type of paper. And as Gary points out in his paper, there are other securities that played an important role in the recent crisis, such as bank repos, that don't have a common pool problem, and they had runs as well. So what we'd like is some kind of a model that doesn't need a big shock to give us a crisis and also doesn't need a common pool problem to give us such a crisis. And so the Dang, Gorton, and Holmstrom model is one model that can try to do that. And just as a skeleton, in terms of the model, you think of it as, they set up a situation where there's three kinds of guys. Let's call them Mr. A, B, and C. And Mr. A is a project. He needs money in the first period, and it's only going to pay off in the third period. Mr. B is the interesting guy. He has an endowment in the first period, but he wants to consume in the second period before the project's going to be ready. So what he'd like to do is he'd like to buy a claim from Mr. A in the first period, but then what he wants to do is get back the consumption in the second period. And the way he can do that is by selling a different security claim to this Mr. C guy, which is going to be backed by the security he bought from Mr. A. And so it's literally the security from Mr. A becomes the collateral that backs the security that he issues to Mr. C. And the wrinkle is that Mr. C is a guy who can generate information and potentially, at positive cost, engage in monitoring of the quality of the project and can decide whether or not to do so. And as the paper shows, in this kind of a setup, debt is going to emerge as an optimal contract. And the reason is because of this information insensitivity. Mr. C is only going to monitor when the value of identifying poor payoffs is sufficiently high. The debt eliminates the upside risk, and that means in most normal times, Mr. C is not going to monitor, and that's a cheap way for Mr. B to raise his money to consume in the period of his choice. However, there could be bad public news that makes Mr. C think, oh, it's more likely that there's trouble and I better look into that. And so at positive cost, he looks into the question of whether or not there's trouble. And this means that there's less potential for beneficial trade and everyone can be worse off. Some corollaries that Gary already talked about are that more complicated instruments are more desirable because they would inhibit the desirability for the agent purchasing the security, this Mr. C guy, of monitoring the value of the underlying assets. And it also implies there's some kind of a role for, of course, ratings kind of agencies or something that would tend to reduce the incentives to acquire private information and mitigate asymmetries of information. So let me turn to some comments. So I think it's clearly a very important research agenda. What Gary and his co-authors are doing here is they're examining crises in environments where we can look at assets that are of the type that played important roles in the recent global financial crisis, such as asset-backed securities and low-risk debt assets. And these emerge endogenously as optimal instruments, and that also can then get into trouble along the lines of the crises that we observe. In addition, the generation of crises are endogenous, but not just sunspots. They can be based on the fundamentals. In the paper Gorton and Ordonez, as the boom builds up, there's less and less information that's garnered about the quality of the assets. And of course, that's great because it's very cheap to intermediate, but that's bad if there's bad news because then all of a sudden you're more overexposed. And that also gives you the desirable feature that a not very bad shock can get you a crisis. And this moves away from the papers such as Kiyotaki and Moore that are what we might call amplification models, where you take a standard macro model, you might introduce some kind of financial friction, and then that amplifies the possibility of a crisis, but you still need a very big shock to get the crisis to occur. So in terms of other comments, I want to say that I'm quite sympathetic to the idea that these crises should be characterized as surprises and that it's challenging to measure a country's susceptibility to a crisis. Systemic crises are infrequent events and they manifest themselves differently over time. So this portends that it might be very difficult based on the characteristics of countries to try to figure out whether or not a country is going to fall into a crisis or not. In a series of papers with Andy Rose, we looked at the previous crisis and we found that even ex post, there were little common characteristics in the determination of performances during the previous crisis. So here's the most recent paper. How did Kwanho do this? Oh, there we go. So you can see here the one that people found worked, bank credit growth. So indeed, countries that had robust bank credit growth going into the crisis seems to have done worse in terms of their fundamentals. But, you know, in terms of all kinds of other kinds of reasonable characteristics that we would characterize as potentially inducing vulnerability, we don't see any kind of correlation between how they looked going in and how they looked going out. Even in the case of credit, if you look at, and this is from our original paper, broader measure of domestic credit growth, there's just nothing going on here in terms of any kind of a relationship between countries' domestic credit growth prior to the crisis and their performance during the crisis. So it's very challenging indeed to think of this as in the sense of the so-called ways that we would need to in the so-called amplification models. And so one seems that we'd be much more sympathetic to some kind of a surprise model, which this kind of model can get us. However, we did see illiquidity in the crisis, and indeed, this is a good picture because it's actually the title of the conference. This is global illiquidity of some type. So here we see, this is the fall of 2008, and this is the V stocks and the VIX index, and you'll all recognize the big spike associated with the Lehman failure. And what I want to show you in this picture, and this is everyone in this room knows this, that at this time, when we had the big spike in equity market volatility and all the crises, what have you, all the failures in the fall, we of course also, looking at this dashed line, saw a major appreciation in the dollar. And you all know what the story behind that. There were substantial exposures of European commercial banks, and there was a big desire for dollar liquidity at the time. And because these banks had all of a sudden faced situations of currency mismatch as assets which were denominated in dollars fell dramatically and left these banks short on dollars and long on dollar liabilities. So the need for liquidity in dollars spiked during this period of volatility. And Andy and I, in a paper in the JIE, we modeled this in terms of the Lagos and Wright model that Tom talked about earlier in his talk, albeit in an open economy framework. And Tom, you said that these open economy illiquidity stories are just generalizations, but sometimes you have to make kind of heroic assumptions, as in many of these open economy Lagos and Wright, and we're guilty of the same. You're saying things like, in the night market, agents are only willing to accept assets denominated in their own currencies. And for things like the euro, that seems a little bit shaky. And so it's not so easy to go to those kind of models, but that's an aside. Of course, what happened with the liquidity crisis is the Fed extended its swap lines, and we saw a rapid decrease in CDS spreads. And so again, it's an indicator that global liquidity is a problem in the sense that giving liquidity to the situation mitigated the problem quite dramatically. So let me turn to the Dgh model. So I think it's very interesting and a really important framework. And I think it's one of these papers that's so important when you read it, you think you've read it already because it's already influenced a lot of people's thinking on the subject. Just one comment that I would make is that while I think it is important, it doesn't apply to everything. It's a very special kind of information setup. So we could think about alternative information setups where we might not get the same outcome as you get in Gordon and Holstrom. So for example, suppose that the securitizing agent, that's Mr. B, was informed instead of uninformed, like he was a bank loan originator or something. Then he is the case of the superior information. And in that kind of environment, if the asset purchaser decided to become informed, that could actually mitigate the asymmetry problem and maybe provide another role for rating agencies. So I think it's a really important paper, but one would have to set up different kind of setups to treat other kinds of financial intermediation. And lastly, just to close, in terms of what do we think about the regulatory implications important literature. As the literature discusses, it stresses the idea that there's this potential for undercapitalization of collateral when assets become information sensitive. And if that's the case, of course, then one could say that adequate capital or collateral requirements could mitigate the probability of undercapitalization. And so this kind of framework lends itself to more stringent collateral requirements. In the case of, so even though small shocks can get you in trouble, you would need a bigger shock holding all else equal to get yourself in trouble. And it contradicts the claim that we don't know what policies would mitigate the probability of a crisis. So in Gary's overview paper, he says maturity transformation can't be regulated away. And of course he's right that we can't kill it off completely. But I do think it's more precise to say that we can do some kinds of desirable restrictions on credit activity, although the framework that we're looking at here makes it very clear that these kinds of restrictions will be costly. And so what we're choosing is an interior solution between costly regulation and the mitigation of potential future crises. Thank you.
All right, I think we're a little bit behind schedule, so I'm not sure we're going to have time for very many questions, but maybe you could indicate if you had an urgent question to sort of put your tent up. But before we got to those, give the presenters a chance to respond to the discussants.
Just want to thank Mark, and let's go on to questions.
I would like to thank Professor Shin for his useful comments. I would just like to make two short comments on what he said, to pick two of his comments. The first one is on the concept of liquidity and the importance of core versus non-core liabilities. And this, I totally agree, that non-core liabilities is the most volatile part of international money or global liquidity. It's the most prone to ebbs and flows in confidence, or it's the most likely to move from the informationally insensitive state to the informationally sensitive state, to use Gary Gorton's typology. So it is very important. It's also important for central banks, by the way, because the expansion of inside money in the form of non-core liabilities, it can command a further expansion of central bank liability, public money, as a reaction to the crisis. So this is where financial dominance, in a sense, is the most likely to be seen. That this expansion of inside money can create pressure on central banks to expand, to step in case of a retrenchment of inside liquidity. So it is very important for us to consider. Second remark is on the role of nominal exchange rate volatility, because you make this point that fragmentation or lack of international diversification is mostly due to nominal exchange rate volatility. Yes and no, because if you take the European experience, we have this experience in Europe of a monetary union, so by definition, no nominal exchange rate volatility, and still, we didn't have perfect diversification even within the euro area, and we had very rapid fragmentation after the crisis. So why is it so that we have financial fragmentation even though we don't have exchange rate volatility? And when you think about it, one reason may be that ultimately bank liabilities, including cross-border bank liabilities, depend on the creditworthiness of their sovereign. So it all has to do with the fiscal backing of private money, commercial bank money. That commercial bank money ultimately is backed by sovereigns in the forms of bailouts, and this fiscal backing remained at a national level. So in a sense, this creates maybe some kind of nominal exchange rate volatility, which is not the apparent nominal exchange rate because it's fixed, but you have intrinsic or shadow exchange rates related to the different creditworthiness of sovereigns, and this has to do with the absence of a common fiscal backing for commercial money. So this, I would say that this fiscal backing is very important also to assess the creditworthiness of commercial money, and to bring in Gary Gorton's framework. In a sense, what happened in Europe is that the threat of default restructuring, which was introduced with the Deauville Agreement, it has eroded the fiscal backing of commercial money. and it has created uncertainty on the value of commercial credit, and it has moved the whole liability structure in Europe from the informationally insensitive state to the informationally sensitive state because of this risk of debt restructuring. So I would argue that that fiscal backing in a monetary union is very important.
Thank you. Maybe we do have time for at least a couple of quick questions. Does that anyone have one? I didn't mean to scare everyone away on my threshold for what it took to speak. Kido Matsumoto, please.
Okay, so I have a question to Berma regarding global liquidity and international risk sharing. I think that the quantity measure or even home bias doesn't imply that lack of risk sharing, or either vice versa, that even there's a lot of capital flow or global liquidity, it doesn't necessarily imply that international risk sharing is improving. There must be some asset allocation issue, and we actually don't know at all in terms of exchange rate hedging, because we need to know a lot of position in terms of option and forward position. So we are actually doesn't know this link, and this is part of the comment is that we don't know, so we probably want to study. But and the other thing is that the global liquidity may be actually not working so much for the international risk sharing, but maybe it's working for the growth enhancement. So it might help other countries to grow faster. That part of the analysis, a little bit also to, sometimes closely related, but sometimes also to the risk sharing. So if you have any view on this.
Care to respond?
No, I don't have a strong view. I mean, I agree that the pattern of cross-border flows is not in itself enough to pass a judgment on financial integration. Obviously, it also depends on the underlying correlation of asset returns, and the underlying correlation of asset returns may have changed after the crisis. So the fact that we see apparent fragmentation or apparent renationalization of savings is not in itself enough to pass a judgment on the degree of financial integration. It could be the optimal reaction to changing asset correlations, but as you say, we don't know enough yet.
All right, Timothy Lane.
Just a brief comment on the repo markets. My understanding was that part of the problem during the crisis was that people thought that the repo markets didn't have a common pool problem, and then they discovered that as the crisis unfolded, there was actually a common pool element because of the rehypothecation of collateral, and also because of the various legal uncertainties related to cross-border repo transactions. And so, although I think that that may not have been the central issue, it was certainly an element. So I invite any comments on that.
I think it's not that important. First of all, we have no idea the extent of rehypothecation, a word which everyone has learned in the last few years. And the only case where there was legal uncertainties was with hedge funds borrowing against collateral in Lehman's London subsidiary, even though we're US hedge funds. So that's all a sideshow. The point about repo is you get your bond as collateral, right? You don't care what anybody else does. You have your collateral. When the crisis happens, that is to say, when the market thinks that there may be information production and adverse selection in the market, that can affect an asset class, right? But you still have your collateral. So you have to be very precise about it. Either everything has a common pool problem because we all live on Earth, or it has to be sequential service. So Doug and Phil are talking about a very precise meaning, sequential service. And other markets don't have sequential service. They're just not set up that way. So that's my only point.
All right, well, thank you very much. A very interesting panel. We should thank our presenters and discussants.